Hello everyone, this is the first episode in my channel, and in this video you'll see those two lines. So the first we will describe what's an edge, and the second question we're gonna answer is why casinos always win, or why the house always win. And in the next episodes, I will show you how to trade like a casino and not a normal gambler. So I'm going to show you something. So what's an edge? Basically, an edge is something or a proof that you can beat the market over time or with consistency. So any strategy in any available strategy is going to make some profits, maybe 1 week of the year, 1 month of the year, or even half of it, or even most times of the year. So anyone can make money, but the question is not if I'm gonna make money now, but the real question is, am I going to be able to make money over time? So consistency is key. So if I click the buy button in any time, the market can go in my favor. So does clicking buy every time will make me profits? Absolutely no. So this is the idea. So edge is a proven strategy that will make you money over time. That's it. So consistent profits. And this is the short answer to an edge. And now I will answer the second question is why casinos always win. Because basically casinos have a statistical edge, and I will show you one example over here. So in games like roulette, we have, it looks like this, and there is many numbers over here, and we're going to take the colors example, of course. There is 18 black and 18 red, and there is two green spots which are the zero. So there is two green. So if I bet on black, then what's my probability to win? It's 18 divided by the whole probability area, which is 36 plus 2, and it's 38. So the gambler probability is 18 on 38. So if we calculate it on with percentage, it's about, I'm gonna multiply it by 100, it's about 47.3. So 47.3% win rate. And of course we have one risk reward ratio, which means if I risk $1, then I will get $1. This is fair enough. Now we're gonna calculate the casino probability. So those two spots or two green spots, no matter what the gambler will choose, then the casino always will win if the ball hits this one. So if, for example, the gambler bets on black, then the rest is the probability for the casino. So here we have 20. The casino probability is 20 on 38, which is the total available probability. So if we calculate it with the percentage, then it's 52.6% for, I forgot, okay, it's 0.6%. So what's the casino edge is casino probability minus casino gambler. I mean gambler probability. So it's this one minus this one, and it's 5.3. 5.3%. So the casino has a statistical edge of 5.3% over the trader. So for every, let me just calculate it. So 5.3 divided by 100. So 5.3 divided by 100 multiplied by $1. So with every spent $1, the casino wins this. So imagine if there is $1,000,000, which is 1,000, 10,000, 100, and million. So every $1,000,000 spent, the casino will make an average of 53K in profits. This is a statistical edge. And now I'm going to show you why having an edge is very important, and it's the only way to make profits. So we have our edge, and every time I took the coin flip, because it's very similar. We have two sides over here. We have the gambler and the casino, so it's very similar to head and tail. So every time we flip a coin, we add $1 if it's head. Head means for casino, and minus $1 if it's tail. So we lose $1 if the gambler win. For 100 flips, 1,000 and 10,000 flips, and show the equity curve for each one. So as we can see over here, over 100 random flips, the first one was losing. So imagine backtesting a strategy, then the first 10 trades you find out you have negative performance, then you will find another strategy. But in the real market, your edge or the strategy you just found is very profitable over long term. So over 1,000 flip, in the first 400 flips we were losing money, so minus $10. Imagine over 400 trades you're losing, even with a proven statistical edge. Can you continue using your strategy? Most of retails won't, so they'll change their strategy, and we can clearly see over a sample of 10,000 flips. Let me just check if I'm recording. Over 10,000 flips, the equity curve is going up and up. So this is long-term proven edge. So what I need you to do is basically find your edge yourself. So how you can find your edge is it's just by trying to find an event. So we have our event with strict rules, and we have rules, and I want you to backtest it a minimum of 1,000 times. If you're not gonna backtest a strategy on, let's say, an intraday strategy that gives you an average of one trade daily, so 5 trades weekly, you're not gonna test it over 50 times. So you can get very positive signals on those 50 times, but in forward, or if you go more further into backtest, you will find it losing. So I need you to backtest it at least 1000 times this time for intraday, because 1000 means, okay, 1000 is let me just calculate how much weeks there is in the week, I mean in the year. So it's 52, and 1000 divided by 52 means, I even forgot what I'm calculating this for, so I have problems in my memory. I will stop the video and I will try to remember what I was thinking about, and I'll come back to you. So 1000 divided by 52 weeks, which is 1 year, is going to take us to 90 years of backtest. And it's a very good time to backtest your strategy to make sure you have a very proven edge. So 90 years covers all the market conditions, let's say growth, recessions, expansion, every market, or the whole dynamic market. So 90 years is very good, or a very good time to prove your edge, and you're not gonna test it for 6 months. 6 months is nothing. So if this 6 months was in growth or expansion, then does your strategy, or will your strategy, I mean, will you make profits in recessions? Absolutely no one knows. So this is, we'll find an event and backtest it so much. Of course, a logical event. So let's take an example. So for example, let's take the S&P 500. The index that covers the biggest 500 companies in the USA. Let's take, for example, let me think of an event. So if, for example, how much, or what's the probability of a winning day after one losing day? So for example, I find it 55%. So this is a very good signal. So every time I find red candle, I will buy the next day, and I will open my position, I will enter my position at the open, and I'll close it or exit at the close. We have 55% win rate, for example. Now, you tell me 55% win rate is profitable because the gambler or the casino made profits with only 52.6% win rate. And I'm going to tell you that it's very complicated, because the gambler has a fixed risk reward ratio of 1 to 1. So what if this, or what if the 45% losses over, or let's say exceed your 55% wins? So this is a very problem. This will take us to uh, losing over time, or in the long term. Of course, excuse me, I'm not very good about, or I'm not very good with talking or using this language. So I hope you understood me overall. So now we're gonna use, or we're gonna add another variables. So for example, we're gonna calculate the average of a losing day. Let me, for the, for example, the S&P 500. So the average of a negative day is 0.85% over the last 25 years. Those data are from Yahoo Finance. So good a good source of data. Now 0. No, this is 0.84% in average, and a winning day has 0.76%. So from the open to the close, we have this ratio, and from the open to the close for a green candle, we have this ratio. So we have 0.76 on average plus, and we have minus 0.8. So what we're gonna do is basically multiply those and multiply those and find which one is more. So if the wins are more, then this is a very good strategy. But if it's not, then in the long term we're gonna lose 100%. Like, of course, there is nothing 100%. So you must imagine you have the best luck ever. You can have 10,000 consecutive wins with only 1% win rate. Just imagine, this is a very possible one. Imagine you can do it before you die. So this is not 100%, but 99.9%. So I'm gonna do right now. I will. So 55% multiplied by the return, or the average return, is 0. Return. I mean, on average. So this is for the wins, or where we're gonna enter. And of course, this is just a theory. It's not real 55%. You're gonna update or upload, I mean, download your data, and then you're gonna study. Yeah, you're gonna have your descriptive analysis, and you're gonna study the probability of your event. You can use AI for this. So, and 0.5% or win rate multiplied on by this return. So we can see that it's 0. Just 0.378. So with this win rate and this average return, it's actually positive, and this is a very good signal. And if I divide on this one, we have 1.1. So what does 1.1 mean is every dollar I risk, on average I will get $1.1 in return, so plus 0.1 USD. So this is a profitable event over a long time, over a long period. So now we didn't finish, of course, but we need to backtest in real market. So this is just theory. In theory or in statistics, we're actually winning, and this is a proven edge. 0.1 or 0.1 USD in for retails isn't enough. Of course, we're having a very small amount of money, let's say 10,000, 100, or even $1 million. So imagine imagine $1 million, or let's say $100,000, which is a very large amount for the average retail. Then you're gonna multiply it by 101, so you're gonna get $10,000 on every $100 you spend. So every time you risk your whole capital, which is if you risk 1% every day, in the end, every day, so you're gonna have about 260 chances the whole year. Anyway, this is a good event, and this is a good edge, but in theory, so those numbers, uh, those win rates were just random, and this is how you can find, or you know what's an edge, and this is why cousin always win. And I just gave you an example of a roulette and an example of how you can find your edge. So this event can be many things, for example support and resistance. So if for example you can calculate this is a resistance and this is support, so it was a resistance, now price break through it, so it will come back and it will act as a support. So what's the probability for price to go from here to this spot? So with this one you can't download the data and calculate the probability. You need a real backtest to see where your win rate is going. So this is why backtest is very important. And of course, you can get the help of AI. Thank you guys for watching this video. I hope it wasn't very long, and excuse my bad English. Thank you guys.